Imagine waking up one morning to find that your money has been working for you while you slept, not through backbreaking labor or endless hours of overtime, but through the quiet, steady magic of investing. This is the reality for those who understand how to make their money grow. Yet, for many, investing seems like an intimidating world, one filled with confusing jargon, unpredictable markets, and the looming fear of making the wrong move. But what if you could unlock the secrets of smart investing without needing a finance degree or years of experience? What if you could take control of your financial future, not by gambling on trends, but by following time-tested principles? Investing 101 by Michelle Kagan is your guide to demystifying the world of investments, breaking down complex ideas into simple, actionable steps. This book isn't just about buying stocks or bonds. It's about building a mindset, one that sees opportunity instead of risk, strategy instead of speculation. Whether you dream of financial freedom, early retirement, or simply securing your future, the journey begins here. Investing isn't just for the wealthy. It's for anyone ready to take charge of their wealth. Let's begin. Chapter 1. Why invest? Investing is the key to growing wealth and securing financial stability. Money sitting in a bank account loses value over time due to inflation, which gradually erodes purchasing power. Even though savings accounts offer interest, the returns are often too small to keep up with rising prices. This means that relying solely on saving money is not enough to build financial security. Investing provides a way to make money work harder, allowing it to grow and multiply over time. The most powerful force behind investment growth is compound interest. This concept means that not only does the initial investment earn returns, but those returns also start earning more returns. Over time, this creates a snowball effect, where even small investments can turn into significant wealth. The earlier investing begins, the greater the benefits, as more time allows compound growth to work its magic. This is why starting early, even with small amounts, can lead to substantial financial gains in the long run. Investing also helps achieve financial goals, whether it's buying a home, funding education, or retiring comfortably. Different types of investments serve different purposes. Some provide steady income, while others focus on long-term growth. The key is to align investments with financial objectives. Understanding the purpose behind investing makes it easier to choose the right options. Risk and reward go hand in hand in investing. Every investment carries some level of risk, but avoiding risk entirely can also mean missing out on potential gains. Balancing risk and reward is essential. Safer investments, like bonds, tend to have lower returns, while riskier investments, like stocks, offer the possibility of higher rewards. Diversifying investments across different asset types reduces overall risk and creates a stable foundation for financial growth. Market fluctuations are a normal part of investing. Prices of stocks and other assets go up and down due to various factors, including economic conditions, political events, and investor emotions. Short-term changes can be unpredictable, but long-term trends tend to show growth. Staying patient and focusing on long-term goals helps investors avoid making emotional decisions based on short-term market movements. Investing is not just for the wealthy. Anyone can start investing, regardless of how much money they have. Many investment options, such as index funds and exchange-traded funds, ETFs, allow people to invest with small amounts. The key is to start as soon as possible and remain consistent. Regularly contributing even small amounts can lead to significant results over time. Understanding the different types of investments is crucial. Stocks represent ownership in a company and have the potential for high returns but also higher risk. Bonds are loans to governments or companies and offer lower risk with steady interest payments. Mutual funds and ETFs pool money from multiple investors to invest in a variety of assets, providing diversification. Real estate, commodities, and alternative investments also offer opportunities to grow wealth. Knowing how each type works makes it easier to create a balanced investment portfolio. Time plays a critical role in investing success. The longer money is invested, the more it benefits from compound growth. Investing is not about getting rich quickly, but about growing wealth steadily over time. Patience and discipline are key. Trying to predict market movements or chase quick profits often leads to losses. Instead, following a steady, well-planned strategy leads to better financial outcomes. Inflation is one of the biggest reasons why investing is necessary. Prices of goods and services increase over time, reducing the value of money. If money is not invested, it loses purchasing power. Investments, especially stocks, tend to outpace inflation, ensuring that money retains and grows its value. Without investing, money saved today may not be worth as much in the future. Having a clear investment plan helps in making informed decisions. Setting financial goals, understanding risk tolerance, and choosing the right investments form the foundation of a strong investment strategy. A well-planned approach prevents impulsive decisions and keeps investments aligned with long-term objectives. Education is a powerful tool in investing. The more knowledge a person has about different investment options, market trends, and financial principles, the better their decisions will be. Staying informed and continuously learning improves investment success. There are many resources available, from books to online courses, that make it easier to build investment knowledge. Investing provides financial independence and security. Whether it is for retirement, emergencies, or personal goals, having investments ensures that money continues to grow. It creates opportunities and provides peace of mind, knowing that financial needs can be met in the future. Chapter 2. Investment Vehicles. Where to put your money. Investing is not just about putting money somewhere and hoping it grows. It's about knowing where to place it wisely so that it works efficiently over time. There are many options, each with its own potential risks and rewards. Understanding them helps in making the right choice, whether it's for short-term gains or long-term security. Stocks are one of the most common ways people invest their money. When someone buys a stock, they are purchasing a small piece of a company. If the company performs well, the stock price rises and the investor makes a profit. But if the company struggles, the stock price falls and money can be lost. Some companies also pay dividends, which means investors receive a share of the company's earnings regularly. Stocks offer high growth potential, but come with high risk since market prices fluctuate constantly. Bonds are different from stocks. Instead of owning part of a company, a bondholder is lending money to a company or government. In return, they are paid interest at regular intervals, and at the end of the bond's term, they get back the original investment. Bonds are considered safer than stocks because they provide steady income and are less affected by market swings. However, the returns are usually lower compared to stocks. Government bonds are the safest, while corporate bonds carry more risk, depending on the financial health of the company. Mutual funds allow people to invest in a mix of stocks, bonds, and other assets. Instead of choosing individual stocks or bonds, money is pooled with other investors, and a professional manager decides where to invest. This provides diversification, which means the risk is spread across many investments. If one stock performs poorly, others in the fund may balance out the loss. However, mutual funds charge fees for management, which can eat into profits over time. ETFs, or exchange-traded funds, work similarly to mutual funds, but they are traded on the stock market like individual stocks. This makes them more flexible since investors can buy and sell them anytime during the trading day. ETFs usually have lower fees than mutual funds and often track specific indexes, like the S&P 500. Since they are not actively managed, costs remain low, making them a popular choice for beginners and experienced investors alike. Real estate is another way to grow wealth. Buying properties to rent out can provide a steady income, and the value of the property may increase over time. Some investors also buy homes, fix them up, and sell them at a higher price. While real estate can be a reliable investment, it requires a large upfront cost, ongoing maintenance, and dealing with tenants if the property is rented out. It is also not as liquid as stocks, meaning it takes time to sell and convert into cash. Commodities include physical goods like gold, silver, oil, and agricultural products. Investing in commodities is different from stocks and bonds because their value depends on global supply and demand. Gold, for example, is often used as a safe investment during economic downturns. However, commodities can be unpredictable since prices can change due to political events, weather conditions, or market trends. Cryptocurrency is a newer investment option. Digital currencies like Bitcoin and Ethereum are not controlled by governments or banks, making them unique compared to traditional money. Some investors have made huge profits from cryptocurrency, but it is extremely volatile. Prices can rise or fall dramatically in a short period, making it a high-risk investment. Since it is still developing, regulations and security risks are also concerns for investors. Certificates of deposit, CDs, and savings accounts are among the safest places to put money. With a CD, money is deposited for a fixed period and the bank pays a set interest rate. The longer the term, the higher the interest earned. Unlike stocks and bonds, CDs and savings accounts guarantee that the initial money will not be lost. However, their growth is slow, and the returns may not keep up with inflation. Annuities are long-term investments that provide regular payments in the future. They are often used for retirement planning. Money is given to an insurance company, and in return, they promise to make payments either for a certain number of years or for the rest of the investor's life. Annuities offer security, but they come with high fees, and once purchased, it is difficult to get the money back early. Each investment option serves a different purpose. Some are designed for quick access to cash, while others focus on long-term growth. Choosing the right one depends on financial goals, risk tolerance, and the time available to let the investment grow. Having a mix of different investments helps balance risks and increases the chances of stable financial growth over time. Chapter 3. The Stock Market, What You Need to Know. The stock market is a place where people buy and sell pieces of companies, called stocks. It is a system that allows businesses to raise money and investors to grow their wealth. Understanding how the stock market works is important for anyone who wants to invest wisely. At the center of the stock market are exchanges, which are platforms where stocks are traded. The New York Stock Exchange, NYSE, and the Nasdaq are two of the biggest exchanges in the world. These exchanges create a marketplace where investors can buy and sell stocks in an organized way. Instead of going to a physical location, most stock trading now happens online through brokers, making it easy for anyone to participate. Every stock has a price, which is determined by supply and demand. When more people want to buy a stock, the price goes up. When more people want to sell, the price goes down. Stock prices are influenced by many things, including company earnings, news, economic conditions, and even investor emotions. Some stocks are very stable, while others rise and fall quickly. This movement is called volatility, and it is a normal part of the stock market. There are different types of stocks. Common stocks are the most popular and give investors part ownership in a company. When a company makes a profit, shareholders may receive payments called dividends. Preferred stocks also pay dividends, but they work differently and usually do not give shareholders voting rights in the company. Investors choose stocks based on their goals. Some people want stocks that grow in value over time, while others prefer stocks that pay regular dividend. Stock indices help people understand how the market is doing as a whole. An index is a group of stocks that represents a certain part of the market. The Dow Jones Industrial Average tracks 30 major companies and gives a simple view of how big businesses are performing. The S&P 500 tracks 500 large companies and is considered a better measure of the overall market. The Nasdaq Composite focuses on technology stocks. Watching these indices helps investors see trends and make informed decisions. The stock market moves in cycles. Sometimes prices rise for a long period, and this is called a bull market. During this time, the economy is strong, companies are doing well, and investors are confident. Other times, stock prices fall for a long period, which is called a bear market. This usually happens when the economy is struggling, unemployment is high, or there's uncertainty in the world. Investors need to understand these cycles so they do not panic when prices drop. Companies sell their stocks to the public through a process called an initial public offering, IPO. When a company first sells its shares, it raises money to grow its business. After the IPO, those shares are traded between investors on the stock market. Buying stocks in a company that just went public can be risky because prices can be unpredictable. The stock market is influenced by many outside factors. Interest rates set by the government can affect stock prices. When interest rates are low, borrowing money is cheaper, and companies can expand, leading to higher stock prices. When interest rates go up, companies may struggle to grow, and stock prices can fall. Inflation, unemployment, and global events also play a role in market movements. Investors use different strategies to make money in the stock market. Some buy and hold stocks for many years, believing that companies will grow over time. Others trade stocks more often, trying to make profits from short-term price changes. Day trading involves buying and selling stocks within the same day, but this can be very risky. Another approach is investing in index funds, which follow stock indices and provide a simple way to invest in a large number of companies at once. There are risks involved in stock market investing. Stock prices can go up and down suddenly, and sometimes investors lose money. Some companies fail, causing their stocks to become worthless. To manage these risks, investors need to research companies before buying their stocks. They should also spread their investments across different industries and types of stocks to avoid losing everything if one company does poorly. This is called diversification, and it is an important way to reduce risk. Investing in the stock market requires patience. Prices will not always go up, and there will be times when the market declines. However, history has shown that over long periods, the stock market grows, and those who stay invested usually see good returns. The key is to stay informed, make smart decisions, and not let fear or excitement control investment choices. Chapter 4. How to buy and sell stocks. To buy and sell stocks, the first step is to open a brokerage account. There are two types of brokers: full-service brokers and discount brokers. Full-service brokers provide expert advice and manage investments for their clients, but they charge high fees. Discount brokers, on the other hand, offer lower fees and allow investors to manage their own trades, making them a better choice for those who prefer to make their own investment decisions. Online brokerage platforms have made stock trading more accessible, allowing anyone to buy and sell stocks with just a few clicks. Once an account is set up, the next step is to fund it. This can be done through a bank transfer, and many brokers require a minimum deposit to start trading. Some platforms also offer margin accounts, which allow investors to borrow money to buy more stocks. However, using margin comes with risks, as losses can exceed the initial investment. Before purchasing a stock, it is important to research the company. Looking at financial statements, past performance, and industry trends helps in making an informed decision. The price of a stock is affected by many factors, including earnings reports, news, and overall market conditions. When placing an order, there are different types of trades to choose from. A market order buys or sells a stock immediately at the current price. It is the fastest option but does not guarantee a specific price. A limit order, on the other hand, sets a price at which the trade will be executed. If the stock reaches that price, the order goes through. If it does not, the trade remains unfulfilled. This option allows for more control over the buying and selling process. A stop-loss order is used to limit potential losses. If a stock price drops to a certain level, the order automatically sells the stock to prevent further decline. This is useful in protecting investments from sudden market downturns. A stop-limit order combines both a stop and a limit order. It triggers a sale once a certain price is reached, but only sells if the stock can be sold at a specified price or higher. After buying a stock, monitoring its performance is essential. Watching price movements, reading financial news, and staying updated on the company's developments help in deciding when to sell. Some investors hold stocks for the long term, benefiting from gradual growth and dividends. Others prefer short-term trading, buying and selling stocks quickly to take advantage of small price changes. Selling a stock follows a similar process as buying. A market order sells the stock immediately at the current price, while a limit order ensures the stock is sold only at the desired price or higher. Deciding when to sell depends on various factors, such as reaching a profit target, changes in the company's outlook, or shifts in market conditions. Another strategy is dollar-cost averaging, where an investor buys a fixed dollar amount of stock at regular intervals, regardless of the price. This reduces the impact of market fluctuations and lowers the risk of making a poor decision based on short-term changes. Trading fees and taxes should also be considered. Some brokers charge commissions for each trade, while others offer commission-free trading. Additionally, capital gains tax applies to profits made from selling stocks. Holding a stock for more than a year results in lower tax rates compared to selling it within a year, which is taxed at a higher rate. Using technical and fundamental analysis helps in making better investment choices. Fundamental analysis focuses on a company's financial health, revenue, profit margins, and management quality. Technical analysis, on the other hand, looks at stock price charts and trading patterns to predict future movements. Many traders use a combination of both methods. Stock market trends also play a role in buying and selling decisions. In a bull market, where prices are rising, investors are generally optimistic, leading to increased buying activity. In a bear market, where prices are falling, selling pressure increases as investors become cautious. Understanding these trends helps in making smart trading decisions. Another important aspect is diversification. Spreading investments across different stocks, industries, and asset types reduces risk. Instead of putting all money into a single stock, a well-balanced portfolio minimizes potential losses. Market volatility is a natural part of stock investing. Prices can fluctuate due to economic news, political events, or company performance. Being prepared for ups and downs helps in making rational decisions instead of reacting emotionally. A well-planned investment strategy, combined with patience and discipline, leads to better results. Keeping up with market developments, learning from past trades, and continuously improving investment skills make stock trading more effective. Chapter 5. Understanding bonds. Bonds are one of the most stable and reliable investment options, offering a way to earn steady returns while reducing overall risk. They are essentially loans that investors give to companies, governments, or other organizations in exchange for interest payments over time. Understanding how bonds work, their different types, and their risks and rewards is key to making informed financial decisions. When an investor buys a bond, they're lending money to an entity that needs funds to finance projects, operations, or debt repayments. In return, the bond issuer agrees to pay periodic interest, known as the coupon rate, and return the full amount of the loan, called the principal, when the bond reaches its maturity date. The maturity date varies depending on the type of bond, ranging from a few months to several decades. Bonds with longer maturity periods typically offer higher interest rates to compensate for the longer wait before repayment. There are different types of bonds, each with unique characteristics. Government bonds, issued by national governments, are considered the safest since they are backed by the government's ability to collect taxes. Treasury bonds, issued by the U.S. government, are highly secure and come with different maturity lengths. Municipal bonds are issued by local governments or states to fund public projects like roads, schools, and infrastructure. These bonds offer tax advantages, as the interest earned is often exempt from federal and sometimes state taxes. Corporate bonds are issued by businesses to raise money for expansion or other financial needs. These carry more risk than government bonds because a company's financial health determines its ability to repay. However, corporate bonds typically offer higher interest rates than government bonds to attract investors. Bond ratings help investors assess the level of risk associated with a bond. Rating agencies like Moody's, S&P, and Fitch evaluate bonds and assign ratings based on the issuer's creditworthiness. Bonds with high ratings, such as AAA or AA, are considered low risk and reliable. Lower-rated bonds, often called junk bonds or high-yield bonds, offer higher interest rates but come with a greater chance of default, meaning the issuer might not be able to make interest payments or repay the principal. Understanding these ratings helps investors balance risk and reward based on their financial goals. Interest rates play a major role in bond investing. When interest rates rise, the price of existing bonds falls because newer bonds offer higher returns, making older ones less attractive. Conversely, when interest rates decline, existing bonds become more valuable because they provide higher returns compared to newly issued bonds. This relationship between bond prices and interest rates is crucial for those looking to buy or sell bonds before they reach maturity. Inflation is another factor that affects bonds. If inflation rises, the purchasing power of the interest payments decreases, making bonds less attractive. Investors should consider bonds that offer protection against inflation, such as Treasury inflation-protected securities, TIPS, which adjust their value based on inflation rates. Diversification is one of the key advantages of including bonds in an investment portfolio. Since bonds are generally less volatile than stocks, they help balance the overall risk. Many investors use a mix of stocks and bonds to create a portfolio that grows steadily while minimizing losses during market downturns. The right balance depends on individual financial goals, risk tolerance, and investment time frame. Bond funds provide an alternative for those who prefer not to buy individual bonds. These funds pool money from multiple investors and invest in a range of bonds, offering diversification without requiring extensive research on individual securities. Exchange-traded funds, ETFs, and mutual funds focused on bonds allow investors to gain exposure to the bond market with added flexibility. Before investing in bonds, understanding their risks is important. Interest rate risk refers to the potential for bond prices to drop when rates increase. Credit risk involves the possibility that the issuer might fail to make payments. Liquidity risk means that some bonds may be difficult to sell quickly without losing value. Managing these risks requires careful selection based on ratings, maturity dates, and financial goals. Bonds are an essential tool for creating a stable financial future. Whether used for generating steady income, preserving capital, or diversifying an investment portfolio, they offer a predictable way to grow wealth with manageable risk. Learning how bonds function, how interest rates impact their value, and how to choose the right types ensures that investors make smart and strategic decisions. Chapter 6. Mutual Funds and ETFs. Mutual funds and ETFs are two of the most common ways to invest in the stock market, and they offer an easy way to build a diversified portfolio without needing to pick individual stocks. Both investment options allow people to pool their money together with other investors to buy a wide range of securities, making it possible to own a small piece of many different companies or assets. This approach spreads risk, which can help protect against large losses if one investment performs poorly. A mutual fund is a professionally managed investment that collects money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. The fund is managed by a professional who decides which investments to buy or sell based on the fund's goals. Some mutual funds focus on growth, meaning they invest in companies that are expected to increase in value over time. Others focus on income, investing in stocks or bonds that pay dividends or interest. There are also balanced funds that try to do both by holding a mix of stocks and bonds. Investing in a mutual fund is straightforward. Instead of buying shares of individual companies, an investor buys shares in the fund itself. Each share represents a portion of all the investments held by the fund. As the value of the investments increases, the value of the mutual fund shares also rises. If the investments decrease in value, the fund's share price will fall. Investors can buy or sell shares of the mutual fund at the end of each trading day, and the price of these shares is determined by the total value of the fund's holdings, also known as the net asset value, NAV. One important factor to consider when investing in mutual funds is the cost. Most mutual funds charge a fee for managing the investments, called an expense ratio. This fee is taken out of the fund's assets and can impact returns over time. Some funds also charge a fee when buying or selling shares, known as a load fee. A fund with a high expense ratio or sales fee can significantly reduce profits, so it's important to choose funds with lower costs whenever possible. Another key point is the difference between actively managed and passively managed mutual funds. In an actively managed fund, a professional makes decisions about which investments to buy or sell in an effort to beat the market. These funds often have higher fees because they require more work to manage. In contrast, passively managed funds, such as index funds, simply follow the performance of a specific market index like the S&P 500. Because they do not require as much management, their fees are typically lower, making them a cost-effective option for many investors. Exchange-traded funds, or ETFs, are similar to mutual funds in that they offer diversification and allow investors to own a mix of different assets. However, there are some key differences that make ETFs unique. Unlike mutual funds, which are bought or sold only at the end of the trading day, ETFs can be traded on the stock market throughout the day, just like individual stocks. This means their prices change throughout the day based on supply and demand. ETFs generally have lower fees than mutual funds, especially when they track an index. Many ETFs have expense ratios that are much lower than actively managed mutual funds, which means investors get to keep more of their returns. ETFs also tend to be more tax efficient. Because of the way they are structured, they often generate fewer taxable events compared to mutual funds, making them a great option for investors looking to minimize taxes. Another advantage of ETFs is their flexibility. Since they trade like stocks, investors can buy and sell them whenever the market is open. Some ETFs focus on specific industries, such as technology or healthcare, while others track the entire stock market. There are also ETFs that invest in commodities, bonds, or international markets. This wide range of options allows investors to tailor their portfolios to meet their specific needs and goals. Despite their benefits, ETFs also have some drawbacks. Because they're traded on the stock market, investors may have to pay brokerage fees when buying or selling them. These costs can add up if trades are frequent. Additionally, ETFs that focus on specific industries or strategies may carry more risk, especially if the sector they focus on experiences a downturn. When deciding between mutual funds and ETFs, it's important to consider factors like investment goals, costs, and how much time and effort is needed to manage the investments. Mutual funds may be better suited for investors who prefer a hands-off approach and do not want to worry about making trades during the day. ETFs, on the other hand, may be a better fit for those who want more flexibility and lower fees. Understanding the differences between these two types of investments can help investors make better decisions about where to put their money. Chapter 7. Initial Public Offerings, IPOs. Initial public offerings, commonly known as IPOs, mark a significant event in the life cycle of a company. An IPO occurs when a private company decides to go public by offering its shares to investors for the first time. This move allows the company to raise capital from the public, which can be used for various purposes, such as expanding operations, paying off debts, or funding new projects. The process begins when a company prepares to transition from private to public status. This requires extensive planning and coordination, as the company must meet strict regulatory requirements. It usually engages investment banks to help facilitate the IPO. These banks act as underwriters, helping to determine the initial price of the shares and the number of shares to be offered. They play a crucial role in assessing the company's value and guiding it through the complex process of going public. Once the company and the underwriters have set a date for the IPO, they conduct a roadshow. This is an important marketing effort where company executives present their business model, financial performance, and growth potential to potential investors. The goal of the roadshow is to generate interest and excitement about the upcoming IPO. Investors have the opportunity to ask questions and gain insights into the company's operations and prospects. After the roadshow, the company files a registration statement with the Securities and Exchange Commission, SEC. This document contains detailed information about the company's financial condition, management team, and risks associated with investing in its shares. The SEC reviews this information to ensure it complies with legal requirements. Once approved, the company can finalize the details of the IPO and begin trading its shares on a public stock exchange. As the IPO date approaches, excitement builds among investors. They speculate on the share price and the company's future performance. On the day of the IPO, the company's shares begin trading and investors can buy and sell them on the stock exchange. The initial trading can be volatile, with share prices fluctuating based on market demand. Some investors may rush to buy shares, believing they will increase in value, while others may hesitate, worried about potential losses. Investing in an IPO can be enticing, but it is important to understand the associated risks. Unlike established companies with a long track record, IPOs often represent newer businesses that may not have a proven performance history. This uncertainty can lead to significant price swings in the early days of trading. Investors should conduct thorough research, examining the company's financial health, competitive position, and growth prospects before making any decisions. There are various strategies for investing in IPOs. One approach is to buy shares on the first day of trading, hoping for a quick profit as demand pushes prices higher. However, this strategy can be risky, as prices may fall after an initial surge. Another approach involves waiting for a few weeks or months after the IPO to assess the company's performance and stability. This allows investors to avoid the initial volatility and make more informed decisions based on the company's actual results. Investors must also consider the lockup period, which is a predetermined period during which company insiders, such as executives and employees, cannot sell their shares after the IPO. This period usually lasts for 90 to 180 days. After the lockup period expires, there can be increased selling pressure as insiders cash out their shares, which may affect the stock price. In addition to individual investors, institutional investors, such as mutual funds and pension funds, often play a significant role in IPOs. These investors typically have more resources and information, enabling them to analyze the company's potential more effectively. Their participation can provide validation and attract further interest in the IPO, positively impacting the stock's performance. Investing in IPOs offers the potential for high returns, but also comes with inherent risks. Investors must remain vigilant and approach IPOs with caution, ensuring they are well-informed and prepared for the uncertainties that accompany investing in newly public companies. By understanding the IPO process, conducting thorough research, and considering both short-term and long-term strategies, investors can navigate the exciting world of initial public offerings more effectively. Overall, initial public offerings present a unique opportunity for both companies seeking to raise capital and investors looking to buy shares in promising new ventures. By grasping the intricacies of the IPO process and the potential risks involved, investors can make informed choices that align with their financial goals. In the dynamic landscape of investing, knowledge and preparation are key to success. Chapter 8: Investment Strategies. Investment strategies play a crucial role in achieving financial success. Different strategies cater to various investment goals, risk tolerances, and time horizons. Understanding these strategies helps investors make informed decisions and build robust portfolios. One fundamental approach is value investing, which focuses on finding undervalued stocks that have the potential for growth. Value investors search for companies whose stock prices are lower than their intrinsic values. They rely on financial analysis to identify opportunities where the market has mispriced a stock. By purchasing these undervalued assets, investors aim to profit when the market corrects itself, realizing the true value of the stock. On the other hand, growth investing targets companies expected to grow at an above-average rate compared to their industry peers. Growth investors look for businesses with strong potential for future earnings and often invest in companies that reinvest profits to expand their operations rather than paying dividends. This strategy can yield significant returns if the chosen companies succeed in their growth ambitions. However, growth stocks can also be more volatile, requiring investors to be prepared for price fluctuations. Income investing is another popular strategy that focuses on generating regular income from investments, often through dividends or interest payments. This approach is especially appealing to those seeking a steady cash flow, such as retirees. Investors typically seek out established companies with a history of paying dividends, as these businesses tend to be more stable and less risky. Real estate investment trusts, REITs, and bond investments are also common choices for income-focused portfolios. The key is to find investments that provide reliable and consistent returns over time. Another essential concept in investment strategies is asset allocation, which involves spreading investments across different asset classes to minimize risk and optimize returns. Asset allocation considers an investor's risk tolerance and time horizon, guiding decisions about how much to invest in stocks, bonds, and other assets. A well-diversified portfolio reduces the impact of poor-performing investments and can help achieve long-term financial goals. Regularly reviewing and adjusting asset allocation based on market conditions and personal circumstances is crucial for maintaining a balanced approach. Diversification within asset classes is also important. Investors should consider diversifying their stock investments across various sectors and industries, as well as geographical regions. This practice helps mitigate risks associated with specific markets or sectors underperforming. By holding a mix of investments, investors can create a buffer against volatility and improve their chances of achieving more stable returns. Long-term investing is a strategy that encourages holding investments for an extended period, often years or decades. This approach allows investors to benefit from compound growth, where earnings are reinvested to generate additional returns over time. Long-term investors typically focus on fundamentals rather than short-term market fluctuations, adopting a buy-and-hold mentality. By remaining patient and committed to their investment choices, they can weather market downturns and take advantage of overall market growth. Conversely, short-term trading is a strategy where investors buy and sell stocks or other assets over shorter time frames, often within days or weeks. This approach can be more challenging, as it requires a keen understanding of market trends and timing. Short-term traders often rely on technical analysis and market indicators to make decisions. While this strategy can yield quick profits, it also carries higher risks and demands more attention and research. Another important strategy is dollar-cost averaging, which involves investing a fixed amount of money regularly, regardless of market conditions. This approach reduces the impact of market volatility, as investors buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy can lead to a lower average cost per share and less emotional decision-making, making it a practical option for many investors. Rebalancing is a strategy that involves periodically reviewing and adjusting a portfolio to maintain the desired asset allocation. As some investments perform better than others, the original allocation may become skewed, leading to increased risk. Rebalancing ensures that the portfolio stays aligned with the investor's goals and risk tolerance. It is a disciplined approach that requires regular monitoring and adjustments to keep investments on track. Lastly, it is essential to consider personal circumstances and goals when developing an investment strategy. Each investor's financial situation, risk tolerance, and future objectives are unique. Chapter 9: Financial Statements and Ratios. Understanding financial statements and ratios is essential for anyone looking to make informed investment decisions. These documents provide a clear picture of a company's financial health, performance, and overall stability. Learning to read and analyze these statements allows investors to make better choices about where to put their money. Financial statements primarily include the balance sheet, income statement, and cash flow statement. Each of these documents serves a unique purpose and offers valuable insights into a company's operations. The balance sheet presents a snapshot of a company's assets, liabilities, and equity at a specific point in time. Assets are what the company owns, such as cash, inventory, and property, while liabilities represent what the company owes, like loans and accounts payable. Equity shows the owner's claims after all liabilities have been deducted from assets. By examining the balance sheet, investors can determine whether a company has enough assets to cover its debts and gauge its financial stability. The income statement, also known as the profit and loss statement, reveals the company's revenues and expenses over a specific period, usually a quarter or a year. It shows how much money the company made and how much it spent to generate those earnings. The difference between revenues and expenses is the net income, which indicates the company's profitability. A strong and growing net income is often a positive sign, suggesting that the company is effectively managing its resources and generating profits. Investors can compare the income statements of different companies to identify which ones are performing better in terms of profitability. The cash flow statement complements the income statement and balance sheet by detailing how cash flows in and out of the business during a specific period. It is divided into 3 sections: operating activities, investing activities, and financing activities. Operating activities include cash generated from the core business operations, while investing activities cover cash used for purchasing or selling assets like equipment or property. Financing activities show cash flows related to borrowing and repaying loans or issuing stock. A healthy cash flow indicates that the company can meet its obligations and invest in growth opportunities. Ratios derived from these financial statements provide deeper insights into a company's performance. Investors often use key financial ratios to assess profitability, efficiency, and financial health. One important ratio is the price-to-earnings (PE) ratio, which compares a company's current share price to its earnings per share (EPS). A high PE ratio may indicate that the stock is overvalued, while a low PE ratio could suggest that it is undervalued. This ratio helps investors gauge market expectations for a company's future growth. Another critical ratio is the return on equity (ROE), which measures how effectively a company uses shareholders' equity to generate profits. It is calculated by dividing net income by shareholder equity. A high ROE suggests that the company is good at turning equity investments into profits, making it an attractive option for investors. Conversely, a low ROE could indicate that the company is not using its resources efficiently. The debt-to-equity ratio is also crucial for assessing a company's financial leverage. This ratio compares total liabilities to shareholders' equity, providing insights into how much debt a company is using to finance its operations. A high debt-to-equity ratio may indicate higher risk, as it shows the company relies heavily on borrowed funds. Investors need to be cautious with companies that have high debt levels, especially during economic downturns. In addition to these ratios, investors should pay attention to the current ratio, which measures a company's ability to pay short-term obligations. It is calculated by dividing current assets by current liabilities. A current ratio of less than 1 suggests that the company may have trouble meeting its short-term debts, while a ratio above 1 indicates a healthy liquidity position. Analyzing financial statements and ratios is not just about crunching numbers. It is about understanding the story they tell about a company. Investors must look beyond the surface and consider the context of the financial data. For example, a company may have a high PE ratio, but if its growth potential is strong, this could be justified. Conversely, a low PE ratio might signal underlying issues that could affect future performance. To make well-informed investment decisions, it is essential to regularly review and analyze financial statements. Investors should not rely solely on one financial metric or ratio. Instead, they should consider multiple factors to get a comprehensive view of a company's financial health. By developing a solid understanding of financial statements and ratios, investors can make better choices and build a more successful investment portfolio. Chapter 10: Taxes and Investments. When it comes to investing, understanding the tax implications can significantly affect your overall returns. Many investors focus on picking stocks or bonds, but neglecting taxes can lead to unexpected costs and decreased profits. Taxes are an integral part of investing, and knowing how they work can help you make smarter financial decisions. Investments can be categorized into different types, and each type has its own tax rules. For example, when you invest in stocks and hold them for longer than a year, any profit you make is considered a long-term capital gain. This is taxed at a lower rate compared to short-term capital gains, which apply to investments held for less than a year. Understanding the difference between these two can help you plan your investment strategy more effectively. Holding onto investments for a longer period can reduce your tax burden, allowing you to keep more of your profits. Another important aspect of investing is how dividends are taxed. Dividends are payments made by companies to their shareholders, typically from profits. Qualified dividends, which meet specific criteria, are taxed at the lower long-term capital gains rate. However, non-qualified dividends are taxed at your ordinary income tax rate, which is higher. It is beneficial to invest in companies that pay qualified dividends to maximize your earnings and minimize tax liability. Tax advantage accounts are a great way to grow your investments while minimizing taxes. Retirement accounts such as 401(k), and IRAs allow you to invest money without paying taxes on the growth until you withdraw it in retirement. This can significantly boost your investment returns over time. For instance, if you contribute to a traditional 401(k), your taxable income decreases, which may lower your overall tax rate for the year. Additionally, some accounts, like Roth IRAs, allow for tax-free withdrawals in retirement, providing a powerful tool for long-term wealth accumulation. Knowing how to leverage tax-advantaged accounts can help you make more informed decisions about where to invest your money. For example, using a taxable account for investments that generate capital gains can lead to higher tax bills compared to holding those investments in a retirement account. This strategy can ensure you are not caught off guard when tax season arrives. Investors also need to be aware of the concept of tax loss harvesting. This technique involves selling investments that have lost value to offset gains in other investments. By realizing these losses, you can lower your overall taxable income. This practice can be especially useful at the end of the tax year when you're evaluating your investment performance. It is important to stay aware of your overall portfolio performance and make adjustments that can help reduce your tax liability. Furthermore, it's crucial to understand how taxes impact your investment strategy. A common mistake investors make is focusing solely on gross returns without considering taxes. This can lead to poor investment choices. For example, if you are considering two similar investments, one that has a higher gross return but also generates more taxable income, and another with slightly lower gross returns but fewer tax implications, the second option may provide better overall returns after taxes. Always factor in taxes when evaluating your investment choices. Additionally, it's essential to keep good records of all your investment transactions. Documenting your purchases, sales, and any dividends received will simplify the tax filing process. When it comes time to file your taxes, having accurate records will help you report your income correctly and take advantage of any deductions or credits that may apply to your situation. Lastly, staying informed about changes in tax laws is critical for all investors. Tax regulations can change frequently, and these changes can have a significant impact on your investment strategy. Following reliable financial news sources or consulting with a tax professional can help you navigate these changes and adjust your investment approach as necessary. By understanding the tax implications of your investments, you can take control of your financial future and make more strategic decisions. Taxes are a part of investing, but with the right knowledge and planning, you can maximize your returns and achieve your financial goals. Making informed choices about where and how you invest, leveraging tax-advantaged accounts, and staying organized and informed can pave the way for successful investing. Taking these steps will ensure that your investments work harder for you, ultimately leading to greater financial security and wealth accumulation. Chapter 11. Behavioral Finance: How Emotions Affect Investing. In the world of investing, emotions can have a powerful influence on decisions and outcomes. Understanding how these emotions affect our choices is crucial for anyone looking to succeed in the financial markets. Many investors face challenges not from a lack of knowledge, but from the psychological barriers that can cloud their judgment. Recognizing these challenges can lead to better decision-making and ultimately improve investment results. Fear is a dominant emotion that can drive investors to make hasty decisions. When market downturns occur or negative news circulates, the instinctive response is often to sell off investments to avoid further losses. This panic selling can lead to realizing losses that may have been avoided if the investor had maintained a long-term perspective. In contrast, a rational approach encourages investors to stay the course and assess the situation carefully, focusing on their long-term goals instead of reacting to short-term market fluctuations. On the other end of the spectrum, greed can be equally detrimental. The excitement of a rising market can lead to overconfidence, causing investors to take on more risk than they should. This often results in chasing after hot stocks or trends without conducting thorough research. Many investors fall into the trap of believing that they can outsmart the market, leading to poor investment choices and, ultimately, significant losses. It's essential to remain grounded and to conduct proper due diligence before making any investment, regardless of how enticing the opportunity may seem. Confirmation bias is another psychological pitfall that investors often encounter. This occurs when individuals seek out information that confirms their existing beliefs while ignoring evidence that contradicts them. For instance, an investor who is confident in a particular stock may only focus on positive news articles or opinions that support their view, disregarding any negative reports or market signals. This selective perception can hinder an investor's ability to make well-rounded decisions and adapt to changing circumstances. A more effective approach is to actively seek diverse viewpoints and information, allowing for a balanced assessment of any investment. Overconfidence can also lead investors to underestimate risks. When individuals believe they possess superior knowledge or skills, they may take on excessive risk, assuming that they can navigate market challenges successfully. This can result in significant financial setbacks when unforeseen events occur. A disciplined approach to investing involves acknowledging the limits of one's knowledge and understanding that uncertainty is an inherent part of the market. Being cautious and well-informed can help mitigate the risks associated with overconfidence. Another common emotional response is loss aversion, where the pain of losing money feels more intense than the pleasure of gaining it. This fear can lead to an unwillingness to sell underperforming investments, as investors hope for a turnaround instead of accepting a loss. This behavior often results in a portfolio filled with stagnant or declining assets, which can hinder overall performance. Recognizing the impact of loss aversion is essential. Investors should learn to make decisions based on logic rather than emotion, allowing them to cut losses when necessary and focus on more promising opportunities. Anchoring is yet another cognitive bias that can affect investment decisions. This occurs when individuals rely too heavily on the first piece of information they encounter when making choices. For example, if an investor initially buys a stock at a high price, they may anchor their future decisions to that price, unwilling to sell it for a lower value despite changes in the company's fundamentals. A more effective strategy involves reevaluating investments regularly and making decisions based on current data and market conditions rather than past prices. To combat these emotional biases, developing a disciplined investment strategy is crucial. Establishing clear goals and adhering to a well-defined plan can help keep emotions in check. This may involve setting predetermined criteria for buying and selling assets, as well as regularly reviewing one's portfolio to ensure it aligns with long-term objectives. By focusing on a solid investment strategy, individuals can reduce the influence of emotions and make more rational choices. Additionally, it can be beneficial to cultivate mindfulness when approaching investment decisions. This involves being aware of one's thoughts and feelings while making choices and recognizing when emotions might be leading to poor judgment. Practicing mindfulness can help investors pause and reflect before acting, allowing for more thoughtful and measured responses to market changes. Chapter 12. Avoiding common investment mistakes. Investing can be a rewarding journey, but many people make common mistakes that can derail their financial goals. It is essential to recognize these pitfalls and learn how to avoid them to build a successful investment strategy. One of the most significant mistakes investors make is failing to diversify their portfolios. Many individuals put all their money into a single stock or a few investments, hoping to achieve quick gains. However, this approach is risky. If that one stock performs poorly, the entire investment can suffer. Diversification involves spreading investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. By holding a variety of investments, if one area underperforms, the others can help cushion the impact. A well-diversified portfolio is like a safety net, helping to protect against market volatility. Another common error is trying to time the market. Many investors believe they can predict when stock prices will rise or fall, leading them to buy low and sell high. However, market timing is extremely difficult, even for seasoned professionals. Instead of chasing short-term fluctuations, it is more effective to adopt a long-term investment strategy. Staying invested over time allows for the benefits of compounding, where earnings generate more earnings. By focusing on long-term goals rather than short-term market movements, investors can avoid the stress and uncertainty of trying to time the market perfectly. Investors often fall into the trap of chasing performance. When they see certain stocks or funds performing exceptionally well, they feel the urge to jump in, believing they will also reap high returns. This behavior can lead to buying high and selling low, which is counterproductive. Instead of following the crowd, it is important to conduct thorough research and stick to a personal investment strategy based on individual goals and risk tolerance. Understanding why an investment performed well in the past does not guarantee it will continue to do so in the future. Emotional decision-making can also be detrimental to investing success. Fear and greed can cloud judgment, leading investors to make hasty choices. For instance, during market downturns, fear may drive individuals to sell their investments at a loss, locking in their losses instead of holding on for a potential recovery. Conversely, during market booms, the desire for quick profits might lead to taking excessive risks. It is crucial to maintain a disciplined approach and not let emotions dictate investment choices. Developing a well-thought-out plan and sticking to it can help investors stay focused during turbulent times. Ignoring fees and expenses is another mistake that can eat into investment returns. Many investors overlook the costs associated with buying and selling investments, such as brokerage fees, management fees, and expense ratios. These costs can add up over time and significantly reduce overall returns. It is vital to understand the fee structures of any investment vehicle and to choose low-cost options when possible. By being mindful of fees, investors can keep more of their hard-earned money working for them. Some investors also fail to regularly review and rebalance their portfolios. Over time, some investments may grow faster than others, leading to an imbalanced allocation. For example, if one stock performs exceptionally well, it may become a larger portion of the portfolio than intended, increasing overall risk. Regularly reviewing and rebalancing ensures that the portfolio aligns with the investor's original goals and risk tolerance. This process involves selling portions of investments that have grown too large and reallocating the funds into underperforming areas or new opportunities. Lastly, many people make the mistake of not having a clear investment strategy or plan. Investing without a plan is like embarking on a journey without a map. It is crucial to define specific financial goals, such as saving for retirement, buying a home, or funding education. A well-defined plan outlines how to achieve those goals, including the types of investments to pursue and the time frame for achieving them. This strategy should be revisited and adjusted as life circumstances change. By avoiding these common investment mistakes, such as lack of diversification, market timing, performance chasing, emotional decision-making, ignoring fees, neglecting portfolio reviews, and not having a clear strategy, investors can increase their chances of success. Building wealth through investing requires patience, discipline, and a willingness to learn. With a solid foundation and a commitment to making informed choices, anyone can navigate the complexities of investing and work toward achieving their financial dreams. Understanding and implementing these lessons can empower individuals to make sound investment decisions and ultimately secure a prosperous financial future.